Hello, everybody. It's John Llodra here from New Harbor for our weekly market and client update. Here it is, Wednesday, November 1st. We just finished another month of the year, October. October is historically a pretty interesting month in markets. In fact, many of the major events or crashes in stock market history have occurred in October. The 1987 crash occurred in October, which I talked about a couple weeks ago. And of course, the crash of 1929 during the Great Depression also was an October event. Not nearly as exciting in October as those events here in 2023, but it certainly was a pretty interesting and quite dynamic month in markets. As the headline of this video mentioned, we saw a technical stock market correction. A correction is defined as a 10% pullback from a recent high. So we've seen that. The pullback that we saw in October triggered that event. It's not a particularly uncommon event. In fact, corrections happen on average a little less frequently than once per year. So don't want to overhype that event. The key is what happens from here. We also saw gold spike rather dramatically in the month of October. In fact, we'll talk about it in a bit, but we saw gold spike above $2,000 an ounce, and just in the waning hours of the close yesterday, the market pushed gold back down below $2,000 an ounce. So it didn't close the month above 2,000, but a really interesting month for gold. And of course, the bond markets continue to be quite volatile and exciting, if you will. But we have seen in recent days what I would describe as a bond market attempting to find a bottom and yields attempting to find a top, because bond prices and yields move in opposite directions. So I'd like to share a few charts just to illuminate that. And of course, here today is another Fed meeting day. So we'll learn from the Fed today their outlook and their job owning, their messaging as to what they see as their future rate policy and monetary policy. So it's always good for some fireworks, even if short-lived on a Fed day. So we'll be watching that closely. But let me share some charts here. We'll put the recent month and recent market action into some pictures here for you. So this chart here is the October returns for different asset classes. You've got, I'd be remiss if I didn't give an update on the so-called Magnificent Seven stocks. These are the large tech stocks, the NVIDIAs, the Apples, the Microsofts, the Googles, Tesla, and so forth, that have really carried the markets quite dramatically higher for most of this year, while most of the market has not participated in such gains. We saw a weak month for those stocks. They were down about 2 3/4%. So too were the major indices. The S&P 500 capitalization weighted return. Basically, that's the return of the S&P 500. And this is what's often quoted as the market return. That is a capitalization weighted return. So the large cap stocks have an undue or very heavy weighting on that index return. So when you have the stocks like the Mag 7 for this year, and we'll get to them in a minute, performing as strongly as they have, the index is brought higher. But if you look at the equal weight return, basically giving each of the 500 stocks in the S&P 500 equal weight, 1 divided by 500 weight, we had a negative 4% month. The bond markets were weak, both the aggregate bond and the longer term treasury, particularly weak. A typical 60-40 stock bond mix was down just under 2%. And none of these are investment advice or indicative of anybody's portfolio. I just need to make that disclaimer. The one bright spot, and small caps, the Russell 2000 was particularly weak. The one bright spot was gold, as I alluded to. Gold had a very strong month, and we'll see gold's been a kind of a stealth performer for much of the last year, in fact 2 years. So let's zoom out a little bit here. Again, this is the month of October. This here is from the July 31st peak of this year. So if you look at stock market performance, the S&P 500 it peaked July 31st of this year. And since then, same picture emerges. All those other indices are down. Gold is actually up a bit, but you see that even the Mag 7 stocks were down almost 9% since the July 31st peak. And of course, we had a bounce yesterday, so that 10% correction on the S&P actually is a little bit below 10% now. So key is where we go from here. Let's zoom out and just look at year-to-date 2023. And this really, in a picture, shows the outperformance of this very small cohort of stocks, the Mag 7, up. And this is essentially an equal weighted construction of that rebalance quarterly. So it's not any particular portfolio, but it just shows the outperformance of those 7 stocks. Whereas if you look at the equal weighted S&P 500, that's actually down on the year, as are many other stock indices. Here again, gold is the one of the surprise stealth performers year to date. And then I'd be remiss if we didn't go back even further to the January 3rd of 2022 peak, almost 2 years ago. We see that pretty much everything is down across the board except for gold. Even the Mag 7, because those cohort stocks got so hammered in 2022 that even this year's massive outperformance hasn't been enough to bring them positive on a total return basis going back to January of 2022. We think we're still in kind of a stealth bear market from that January of 2022 high, even though there's been pockets that have been in bull markets. The broad markets we think have been in a stealth bear market, and we think that's more to come, and that doesn't rule out rallies in the short term here. In fact, we think structurally that could very well happen. The key question is, where do we go from here? Now, we've talked a lot about valuations in the stock market. We remain very, very overvalued from a long-term perspective. And these kinds of the valuation levels that historically have given rise to, at the very least, very poor passive long-term returns in the stock market. But they've also been the fodder for further abrupt downside. We'll look in a minute here. There's a lot of technical indicators that are suggesting we're getting in the oversold, what we'll call the oversold realm of the stock market. And that simply just means that sometimes things pull back too far, too quickly. It's not that they've reached a durable or what we might call a fair value bottom, but just like most things in life, things swing like a pendulum. And sometimes when markets move so quickly downward, they have a reflexive rebound. And we think that's quite possible, even if ahead there's further lows. We can't ever rule out a risk of further, if you look in history, the crashes, so to speak, they've almost always happened from oversold levels. So oversoldness or things being overdone on the short term just simply speaks to the probability of a reflexive bounce, but it's certainly not a guarantee. And I would describe the environment as very asymmetric. Maybe there's a higher probability for a short-term bounce of some degree, but there's still perhaps a smaller probability of a much larger decline. And the degree of those declines, if you go back and look at major events in history, can be massive. So it's an asymmetric type of situation. So the long and short of it is, even if there's good reason to become constructive for a short-term possible rally, we think it's still, given valuations and other broad technical and fundamental factors, we think it's still very important to be relatively and quite defensive here. I'm talking about position sizes being modest, having belt and suspender hedges to rule out or mitigate the possibility of a major further decline. But we're looking very closely at technical factors and very well may become somewhat more constructive here in the short term given these readings. I thought it'd be fitting to share a quote that I came across, actually an excerpt from a book here. This is an excerpt from a book called The New Market Wizards, Conversations with America's Top Traders. Came across this past week. It was actually posted up on Twitter or X, whatever you want to call it. And this is by Stan Druckenmiller. And the excerpt from the book was basically a question: what determined the timing of your shift from bullish to bearish? Now, Stan Druckenmiller is a legendary investor, was very much prescient about the 87 crash and navigated that, as well as many market cycles, quite presciently. And he writes here, it was a combination of a number of factors. Valuations had gotten extremely overdone. The dividend yield was down to 2.6%, and the price to book ratio was in an all-time high. Also, the Fed had been tightening for a period of time. Finally, my technical analysis showed that the breadth wasn't there. In other words, the market was very narrow. And he says the market strength was primarily concentrated in high capitalization stocks, with the broad spectrum of issues lagging well behind. This factor made the rally look like a blow-off. Now, if that doesn't describe in words very much the same picture that we have today, I don't know what does. History doesn't repeat itself, but it rhymes. But those kinds of conditions are very much present today, and certainly not a guarantee or a prediction that we get that kind of abrupt further crash. But it just speaks to that the environment is permissive, and certainly couldn't rule out those kinds of events, especially with the geopolitical conflicts going on. There's some major tectonic shifts going on in global central bank policy. We talk a lot about our Federal Reserve and their interest rate policy, but big news of recent days is the Bank of Japan, which one might think, well, what does that have to do with us? Well, it has a lot to do because there's major currency moves. The Japanese yen has weakened dramatically relative to the dollar, and Japan has been traditionally large creditors of lenders to the U.S., basically buying our government debt. And they have just announced an intention to let their yield curve control policy essentially float and essentially move the goalposts quite dramatically. So that could actually rip. I'm not going to get into a whole dissertation on that, but that could unleash a pretty dramatic wave of events here, especially because the carry trade globally has oftentimes many times over the bunch of years behind us here use the yen as a source of low cost capital to fund the carry trade, and that just speaks to leverage and build up within the system. So crash risk aside, I want to focus a little bit on some technical indicators that kind of give us a shorter term picture of the market. So I'm going to go back and share some charts here. So this here is a chart, and this is courtesy of Dorsey, Wright and Associates, NASDAQ Dorsey Wrights. And basically what this shows is for a bunch of different market indices and asset classes, a spectrum going from left to right of what we would call oversold or overbought readings. Basically, if you think about a trend or a moving average for a given asset, it's very natural for that asset to fluctuate up and down around that average. And the more extreme to the upside or downside it becomes, we say it becomes oversold in the case of moving dramatically below that average, or overbought in the case of moving dramatically above that average. And this metric shows essentially a reading of 100%. These are percentages. So a reading of negative 100% basically means it's about 2 standard deviations below the roughly 50-day moving average. Essentially quite an extreme oversold reading. Now certainly can get more oversold, but you see some things here. You see small caps, IWM, the Russell 2000. You see term bonds as measured by TLT. On the other end of the spectrum, you see the dollar is a bit overbought. Gold is a bit overbought, but not extremely so. And that certainly bodes for at least near-term possible consolidation in gold. But you see things like the NASDAQ QQQ, NASDAQ 100, not at all extreme by historical measures. Okay, and this is just one metric of overbought, oversold. The broad takeaway here is, on average, we're a bit oversold here for stocks, and that certainly could be some fuel for a short-term bounce here in the near future. And there's plenty of other readings. We could look at percent of stocks below their 50-day moving average. When that gets extreme to the downside like it is now, it's oftentimes indicative of a likelihood of a bounce. Not a guarantee, but a possibility or probability. So we'll position accordingly. The next chart is just a further look at this. So this looks like at the NASDAQ, and this is a different kind of chart called the point and figure chart. I won't get into the details there. And again, this is a courtesy of NASDAQ Dorsey Wright. But it basically shows, if we look at correction statistics over time, the median correction for the NASDAQ is about 14%. Correction is technically defined as a 10% pullback or more. Median correction is 14%. Average is about 17% downside, and the bear market threshold is a 20% or more correction. So here we are. This is as of a few days ago, the 27th. So you can see here this BLT stands for bottom. That's basically a 2 standard deviation move below the moving average. So it's quite possible we see some further downside, even just to get to the median correction, and that would be consistent with about a 2 standard deviation move below the 50-day moving average. But it's quite possible we get down to an average. So all to say is these oversold readings aren't guarantees of a imminent bounce. It's just the possibility or probability has increased, but we certainly could see further downside. And again, I'll remind folks that oversoldness doesn't guarantee in any way whatsoever a bounce. In fact, some of the biggest crashes have occurred from very oversold levels. So let's look at a couple charts. I'll pull up a couple charts of the S&P 500 and gold just to kind of tie things together, and then we'll conclude this video. Certainly we'll be back next week with another video. But I'm going to share a different chart here for the S&P 500. So this is a daily chart of the S&P 500. This goes back 2 years. So this right here is the January 3rd of 2022 peak, and we saw major decline in 2022, hit a bottom in October, and we've had a pretty good rally from October through the end of July of this year. And then here's this correction that we've seen over the last several handful of months. Pretty sharp rally the last couple of days. We'll see if that follows through. But a couple key points I want to point out here. This blue line here is what's called the 200-day moving average, and you can see we breached that right here. And any of these technical indicators you want to see follow through and confirm breakdowns or breakouts. And so far, this has stayed below the 200-day moving average. So far, that sell signal has been confirmed. Now, if we challenge that and come back above that, perhaps we'll call it a reversal. But you see here, this other line, this fuchsia line, is the 50-day moving average, and that's, I'm sorry, the 2 standard deviations below the 50-day moving average. So anytime you get that oversold on a short-term basis, it's oftentimes, as you can see here and see here, a pretty decent probability of at least a short-term bounce. So that's what we've seen so far. Question is whether that will follow through. There's plenty of technical indicators that I won't go through. We can get into Fibonacci series and things like that. But we think that near-term support is in the 4,100 and change, maybe down to 3,950 or so. We're in a range here where we think this is an important battleground. Very well could be tracing out some support for a move higher. But if we break down from here, that would be, in our minds, an indication that a bear market that we believe started in January of 2022 is likely going to have some further legs to the downside. So let's look at a quick chart of gold. And I'm going to look at this on a monthly basis. I know we've talked about gold quite a bit. Long cup and handle type formation. This is multi-year. This is going back 20 years. And this is GLD, an ETF that tracks gold. So you had this massive rally in the early 2010s. Pretty dramatic pullback, but forming this cup and this handle. And we've got this triple top pattern here. We've got 3 successive attempts at new highs here. Now this bar right here is the month of October, very massive move higher, and we've stalled out so far just below $200 an ounce. We again it poked above there, but got pushed back before the close yesterday, the last day of October. So the question is whether we break out to new highs. Our anticipation is that it's quite likely we do, and we would see say something like 2,500 on the upside for gold to be a reasonable target in the short term. But it wouldn't surprise us to see some consolidation here in the near term. So I'm going to basically wrap it up here. I think enough charts for today, but hopefully you can see that it has been a very dynamic market, and we continue to watch things very closely and continue to emphasize defensiveness. But we're going to be very opportunistic as we watch some of the shorter term technical indicators. As we begin the last 2 months of the year, it's always timely for us to be thinking about and have conversations with our clients about year-end planning, especially tax planning. Capital gains and losses are a topic that we oftentimes will talk with clients about this time of year. We, as investment managers, we certainly don't get everything right, and there are oftentimes holdings that we have put in client accounts that have not worked out, and we can make lemonade out of those lemons by harvesting tax losses. So things like the longer term bonds that we entered a position. Some of those have decent losses that we will likely try to harvest some losses before we get to the end of the year. But for individual clients, please reach out to us if you have specific situations, whether you have losses that you booked elsewhere, or you have capital gains that you've booked this year, perhaps due to a property sale or some other business sale, whatever the case might be. Let's have a conversation about that so we can optimize your situation from a capital gain and loss situation. But well, that's about all I wanted to cover this week. A little longer than I had hoped, but I hope you found it helpful. And we'll be back next week, as we always do, with our New Harbor video. I wanted to make a quick point. Some of you may have noticed that we haven't issued a video with our friend and collaborator, Adam Taggart, the founder of Wealthion. There's some pretty exciting news that came out this week. Adam has decided to forge a new path and start up a new presence. And we're very excited. We have no doubt that Adam is going to make great things of his new venture. And as good friends and collaborators with Adam for more than a decade now, we are absolutely certain that we will continue to have a strong and very, very admiration-filled relationship with Adam, and that this new chapter is an exciting one for all of us as we collaborate together going forward. But do please reach out and find Adam and his new outlets. We'll certainly share information about that as he gets up and going. But until then, thank you for watching, and don't hesitate to reach out to us. We're here for you, and wish you a very good day. Thank you.